rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Is the JSE still a good place to grow your wealth? If you've been investing or thinking about it, you've probably heard some concerns. Companies delisting, the rise of offshore investing, and economic uncertainty. So what does this all mean for your personal investment portfolio? Should you be doubling down on local stocks, diversifying offshore, or looking at alternative investments? To help us break it all down, we have Sean Kelly, a wealth manager at Parity Wealth Managers. Welcome to the show, Sean.
Hi, Tumi. Great to be on with you.
Sean, the JSE has been the main place where South African investors can grow their wealth. But with recent changes like companies delisting, is it still worth investing in it?
I think the JSE has been a significant, there has been a significant decline in listed companies, dropping from 713 in 1990 to 278 by the end of 2023, a 61% decrease. In 2022 alone, we saw 13 companies delisted, followed by 12 delistings in 2023 and 11 last year. Meanwhile, new listings are low. There was only 3 in 23, 5 in 22, and 9 last year. Therefore, this trend does raise concerns about market concentration and shrinking diversification in South Africa. But that being said, the JSE still remains a robust market and does rank among the world's top 20 largest stock exchanges with a market cap of over $1 trillion. But it is, to give a bit of perspective, Apple alone has a market cap of $3.3 trillion, more than triple the entire JSE and about 8 times South Africa's total GDP. So while the JSE can still contribute to an investor's portfolio, diversification remains essential, and investors must look beyond local markets to manage domestic risks and hedge against the rand appreciation.
Sure, some personal finance experts suggest a core satellite strategy where you keep a stable foundation like ETFs and then add growth assets. Does the JSE still have strong core options for investors?
To an extent, it does. Core options remain, in the JSE, mainly through ETFs that track major indices like the JSE. And these ETFs do provide broad market exposure at low costs, making them a solid choice for core allocations. And what we've seen is this strategy has been sound because recent reports show that only 32% of domestic equity managers have actually outperformed the general index. And zooming to a global perspective, over the last 10 years, 100% of South African-based fund managers investing in global equities have failed to outperform the general index. So compelling arguments have emerged for having core ETF allocations as the majority of your portfolio. And investors also need to incorporate offshore assets into their satellite investments to achieve optimal diversification and growth potential.
Just going back to the topic of delistings, with fewer companies listed or listing on the exchange, what risk does this present to investors?
Well, the shrinking number of, listed companies introduces several risks. I think, the first one to highlight is concentration risk. A smaller stock universe can lead to market concentration in a few dominant sectors. The JSE, for example, is heavily tilted toward commodities and financials. And large companies like Naspers and First Rand hold substantial influence. Naspers, for example, which has a market cap of around 840 billion rand, accounts for around 4.4% of the total index. So these large allocations on any given day can move the entire index. But it should be noted, this trend is prevalent in offshore markets as well. The S&P 500, now the top 5 companies make up almost 30% of the entire market. But it does also introduce liquidity risk. Of course, fewer listings mean lower trading volumes, which makes it harder to buy or sell shares without significantly impacting prices. Lower liquidity can also increase volatility and transaction costs for the investors. And then, of course, there's also diversification limitations. A limited selection of investable stocks makes it challenging to build a well-diversified local portfolio, which I suppose just reinforces the case for global diversification.
Now, for someone who has a retirement fund or a tax-free savings account invested in JSE-listed ETFs, should they be concerned about their long-term returns?
Yes, it's important to stay mindful of how markets evolve. While ETFs tracking broad indices provide some diversification, their long-term performance heavily depends on the health of the underlying market. And of course, as we know, South Africa, the economic health has been relatively poor over the last couple of years. And, just to put this in context, if we look at the global stock exchange represented by the MSCI World, we note that over 10 years in Rand terms, it's done an annualized return of 13%. By contrast, the JSE has had an annualized return over that same 10-year period at 4.7%. So offshore markets have essentially outstripped the South African market by an average return of 8.4% each year, year on year for the last 10 years. And, if you're looking even at a more tech-orientated index like the NASDAQ, over 10 years, it's had an annualized return of 20%, outstripping the local market by 15% each year. So it is important to look at, broader markets. And a lot of this has to do with how the Rand has performed. You'll note there in the graphs that I've sent through is that, in 2005, our Rand was trading at R5.85 to the dollar. Of course, now it's sort of blown out to around 1840. And over that 20-year period, I think what's interesting is that the Rand has only appreciated to the dollar 6 times. Every other year, the dollar has actually appreciated to the Rand or strengthened to the Rand. And the net result is the dollar has appreciated by 141% to the Rand during that time period. So reviewing your investment strategy regularly and incorporating offshore assets can enhance diversification and improve return potential over the long term.
Sean, we've seen an increase in passive investing and offshore diversification among investors. Does this impact the liquidity and attractiveness of the JSE?
Yes. The increasing shift toward passive investing and offshore diversification is influencing the JSE's liquidity and overall appeal. Regulation changes such as amendments to Reg 28, which allow for greater asset allocations to offshore assets, have amplified this trend, with capital increasingly flowing offshore into passive investment vehicles. Domestic trading volumes may decline, potentially increasing volatility and trading and costs for the local investors. And of course, reduced liquidity with fewer new listings could make the JSE less appealing to both local and foreign investors.
Given all these dynamics, where do you see the opportunities for South African investors on the exchange in the next 5 to 10 years?
Well, in theory, South Africa's status as an emerging market should create opportunities for active managers to outperform passive managers, especially if limited listings continue. So this environment allows active managers to selectively identify winners, potentially outpacing the overall index. And I think in South Africa, in a few key sectors, mining, the sector, as we know, is vital for our economy. It contributes around 6% to our GDP. And we still think it has potential for long-term opportunities due to its significant role in the economy. And it's a similar story for financials. It accounts for around 5.5% to 15.5% of our GDP and employs around 2.9 million people, which is around 18% of the country's entire workforce. And what we've seen is the presence of more than 5 banks in the top 40, with the recent profitability of banks like Discovery, are indicating strong competition and potential for future growth.
Just going back to the offshore topic, how much of an investor's portfolio should be in local versus offshore markets, and which offshore investments should South Africans target?
Well, I think the fact is South Africa makes up less than 0.3% of the global equity market. So overlooking the remaining 99.7% could be a costly mistake in the long run. And although South Africa has a strong investment landscape, or relatively strong, there are certain sectors like technology, biotechnology, and lithium, for example, that are not represented locally. For example, lithium is crucial for energy storage in this, push to global transition for clean energy, yet there are no direct investment options for it within South African market. So investors must consider looking at global markets to get exposure to these sectors that are underrepresented in South Africa and offer high growth opportunities. Ultimately, investing offshore as part of your long-term strategy helps spread your risk across different economies and sectors. This way, if one region or market underperforms, your overall portfolio still has the potential to generate returns elsewhere. And it reduces your risk of overexposure to a single country or currency. And the balance between local and offshore investments really depends on the individual, financial goals, risk tolerance, investment horizon. But what I would say is it's important for investors to look at the overall wealth, not just the investment portfolios, but also, assets like their home, their businesses, their vehicles, other holdings, because they might realize they have more local exposure than they realize.
Just lastly, Sean, with the current market uncertainty, especially regarding US President Donald Trump's policies, how is it affecting the local market, and what should investors do to protect and grow their wealth?
Yeah, it's a tricky question. I think there's a lot of moving parts. I mean, obviously we've seen some erratic movements, both locally and offshore, and how the rates and the rand is going to be affected by this. But ultimately, looking at the facts, the US is a massive trading partner for South Africa. From an export perspective, it's our second largest exporter, only behind China. And we export around $13 billion to them in 2023, such as platinum, vehicles, and other precious metals. And over the past year, we've actually seen a steady growth in our exporting increase at around 9% with the US. And it's a similar story with our import. The US is our third largest importer, only behind China and India. And these trade policies are in place, and they currently are at jeopardy, of course. I think the South African Growth and Opportunity Act, AGOA, which South Africa is currently eligible for, is at risk. And, it's a scary time because it does provide significant US trade policy benefits for South Africa, giving us access to export over 1,800 products. And the arrangement enhances economic growth and promotes trade. So what we've seen now, of course, is in February this year, President Trump signed an executive order to address alleged serious human rights violations occurring in South Africa. And this was on the back of South Africa filing a genocide case against Israel, in the International Court of Justice, LADR, and the recent Expropriation Land Act. So what we've seen to this point is the US, is holding aid, not just to South Africa, but other countries. But, things like US aid are affecting us. And what makes it so effective for President Trump in geopolitics is the sheer economic power of the US. And it has the potential to derail South Africa, that's already a struggling economy. So at this stage, the main, I suppose, takeaway is to stay diversified, have offshore exposure, and make sure your rand is hedged against the dollar, other major currencies.
All right, we're going to leave it at that. Thank you for joining us on this episode, Sean.
Thank you, Timmy.
That was Sean Kelly, a wealth manager at Parity Wealth Managers.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.